Welcome to this Fund Manager Q&A brought to you by Livewire Markets. My name is Vishal Tekshidani, and today I'm joined by Adam Grotzinger from Chicago. He's from Neuberger Berman, and we are going to talk about the outlook for fixed income and why Neuberger reckons that the outlook for bonds is favorable despite what we're seeing in the macroeconomic environment. Adam, it's a pleasure to have you here. Thanks so much for joining me.
Sure thing. Pleasure to be here.
No worries. So, Adam, let's kick off with that bullish view you've got in fixed income, and against the backdrop we have with COVID, there's so much uncertainty for businesses operating with all these lockdowns, and of course we've got low interest rates. Why are you bullish on fixed income?
Yeah, sure. Certainly, as you say, there's a lot of uncertainty out there in the market, and a lot of variables and data points coming in on the economy and how markets are responding to that. Underpinning our view as we look to the end of 2020 and even beyond into 2021 is that the growth outlook on a forward-looking basis really remains supported, and in particular, that's being enabled by low interest rates, ongoing accommodative monetary policy and monetary policy guidance, which has all kind of filtered into general easing of financial conditions. I think if we take a step back and we contrast and compare this environment to, say, 2008, we're at zero again. But I think the difference in the reality this time round is that this zero bound is being predicated by a Fed and a central bank environment, which is bringing a lot of credibility to keeping these rates anchored at zero. And that's a very different and a contrasting environment to 2008, where rates went to zero, but the market and pricing in terms of volatility of sectors around the market's anticipation of rising interest rates after the crisis is a very different experience today. And so when you look through the financial markets, you're seeing things like government bond rates much less volatile as a function of this new central bank guidance that we have, in particular by the Fed, and that's feeding through in a very strong transmission mechanism into other sectors of the market and how they price, given the underlying kind of stability of government bond curves, notably the credit markets.
Adam, there is a view, and is it fair to say that credit is actually just really doing well because of the vast amounts of fiscal stimulus we have that presumably is temporal, because governments do need to support the economy, and of course quantitative easing and the Fed snapping up bond ETFs. Is credit actually just doing well because of that?
So the first point we'd say is central bank policy, even the fiscal response that was very strong in the beginning, have been important stabilizers to the credit market. So, we shouldn't underestimate the power and the transmission that's brought to credit markets. And notably, the most important aspect has been the reliquefaction of the credit market. So these companies can tap the public debt markets for their balance sheet needs, for their financing needs. And we're not creating liquidity events that translate into solvency events, right? And so that's been very important. The Fed's been really active, notably in treasuries, notably in agency mortgages, somewhat in credit. That's been kind of lesser in extent and more kind of an expectation and guidance about the tools and the levers they can pull to continue to stabilize that market. So, yes, to answer your question, it's important. But if we look under the hood one layer further, we're also seeing things on the fundamental side that are encouraging. On the one end, there's defaults, as we would expect in some segments and most vulnerable businesses in this economy. But on the other end, the companies that can survive have actually been issuing debt and tapping these markets to buffer their balance sheet and also, use debt proceeds, which is encouraging for us, not in an equity-friendly fashion, but rather in a creditor-friendly fashion. So you're seeing less share buybacks. You're seeing greater use of debt proceeds just for terming out debt and refinancing, as an example. And that goes along with some of the earnings profiles of these businesses, which have also, at least on the solvent end of the spectrum, been encouraging in terms of cost management and flexible cost structures, and how these companies are navigating this COVID reality in their respective economies.
And is that the key for you as a fixed income manager? Specifically, when you think about credit, it's segregating the solvent companies from what would be zombie companies just issuing and feasting on cheap debt.
Absolutely. And what I would say is, even when we look in the rearview window, a lot of the perspective on fixed income markets is, spreads are tighter in credit markets from March, obviously. But that doesn't kind of go the step further of looking through company by company or rating spectrum differentials to see that there's still a lot of value out there in the credit markets, and that dispersion is elevated, and really taking an active approach to understanding these businesses, understanding their structures, understanding their let's say economic sensitivity to this economy, and how they can weather this storm is really important. And in light of that, the spreads have compressed. The spread you're getting for many of these companies, we still think is attractive for the relative risks and the lesser default risk that these businesses have in this reality, and particularly at the start of a new credit cycle for these businesses, right? The old credit cycle's ended, a new credit cycle has started afresh.
Okay, I want to turn to multi-sector portfolios in a second, but I find that really interesting. What does it mean when you say a new credit cycle? Give investors some quantification. What are the yields or spreads you can expect?
Yeah, sure. So, new credit cycle, means that we're going through a default cycle, right? And we're starting afresh. And so if you put that in perspective, let's look at large markets just as an example. The U.S. high yield market, for instance, we're anticipating around 9% cumulative defaults for this year and into next year, 2021. The high yield EM, or emerging market, sovereign market, as another example, is going through its default cycle. We're anticipating around 8% defaults. But today versus maybe at the start of this crisis, we have a lot more visibility into where that capital destruction is going to happen. And a lot of that is in the pricing of the market. So for instance, the high yield market's pricing for about 10% of the market for stressed type of environment and a restructuring of capital. And so that leaves a lot of the kind of, call it the performing end of the market, looking attractive in terms of its valuation. And I think in light of an environment where there's yield starvation that's going to go out for many years now, given central bank policy, the value of that yield premia or that spread premia relative to relatively low default risk is very attractive, and in our view still has room to tighten, both in investment grade markets and in high yield markets.
How attractive? Give me a return figure.
Yeah, sure. So, if we look out 12 to 18 months from now and we think about the investment grade corporate credit market, and I just use like index level spreads as an example, we could see that going from its current 120 to 130 spread to back down to its historic tights around 90 basis points. We could see the performing end of the high yield market going back down to, X the defaulting end of it, into a range of spreads of 300 basis points, call it, over treasuries. And let's not forget, this is, not only, still attractive relative to its historicals, but also relative to just this cash rate level or government bond level, which is, benign, negative, or shockingly low just in outright nominal terms. So that multiple of yield you're getting arguably is more valuable today versus, a previous couple years ago.
Okay, thanks for that. Now, I guess in any environment, diversification is king. It's important. So what I want to learn for you today is the case for multi-sector fixed income portfolio construction. What does that mean? What does the strategy entail?
Yeah, sure. I mean, there's a lot of ways when you say multi-sector portfolio that you can put the pieces of the fixed income market together and achieve different objectives. So let me put my comments in the context of putting together these pieces for an outcome that, gives you an attractive return relative to the risk you take, and the risk being kind of investment grade fixed income risk, so kind of a higher quality risk bias. I think the case for that is very strong, and it's evidenced in, how markets have behaved this year and the opportunity set that's unfolded, right? Coming into COVID and the immediate kind of sell-off in markets we saw, it was broad-based across fixed income. But I think the question you always ask yourself in fixed income is, where is that value not only most apparent, but where can we monetize that value with high levels of confidence? And in different markets, the answer to that question is going to change. In the context of this kind of COVID economy in March, our strong view in multi-sector fixed income was to exploit that cheapness in the high grade ends of the market. Everything was cheap, but we felt that high grade was the most compelling value, and we had the highest confidence in, again, monetizing that. And so in hindsight, the March till, say, July period saw us take advantage of that, saw us realize gains on that book and actually take profit on those positions coming into mid-late summer. The reality in fixed income is that those opportunities continue to morph. So for instance, in July and August now, our thoughts have changed to that relative value is shifting. It's moving away from the high grade end of the market where spreads were wide and attractive to tighter today into more nuanced ends of the credit market that are slightly lower in quality, but more focused on, specific segments of the market. For instance, double B, high quality, high yield, and selective triple C issuers that we think actually look like single B credit quality types of names that can be upgraded through time. Or in the emerging market space, names that are high yielding sovereigns, X the problem children default end of that universe, like your Argentinas or Ecuadors, et cetera. So there's a lot of, let's call it security selection opportunity in the market still, but you have to sift through a lot of that headline level noise that you get in fixed income.
And I think that's the key there, Adam, what you mentioned, avoiding the problem children. Nobody wants to have problem children. um, so when I hear some of the credit spectrums that you're targeting here, triple B, triple C, ex Argentinas, I guess, walk us through your process. How do you identify an issuer who you're sure about is going to give you your money back?
Yeah, so there's really two parts of our process, and there's, these both contribute to how we make money for clients. One is, where do we rotate that marginal dollar to? So kind of what area of the fixed income market presents the best relative value? And then when we're within that market, say we identify it as attractive, how do we screen out, the best names and the line items to put in our portfolios in collaboration with our research analysts that are focusing on that day to day? On the asset allocation front, we have a long-standing process where, simply put, we spend a lot of time with our sector teams that live and breathe in these markets to think about what is our forward return expectation, and not just kind of a number, but what does that return expectation look like? How fat is the left tail? How confident, again, am I in monetizing this opportunity? And so that's really the process here. Identifying return, but comparing it to conviction levels and confidence, and building portfolios around things that have less tail risk and kind of more certainty in outcome, or even upside to outcome versus downside. So avoiding massively negative asymmetric returns, and then working with the teams to identify, populating those portfolios really on a best ideas individual security level basis.
How many securities do you tend to hold for diversification? And give me an idea around things like position sizing.
It can vary, but I'd say in a well-diversified portfolio, we're looking at 500 to 600 names. That would include risk-free spectrum like, agency mortgage pools or treasuries or TIPS, in addition to credit. And then in portfolios as well that we manage that are exclusively investing in credit, we'd have a smaller kind of subset of holdings. I would put it in kind of the 300 names type of realm. So we certainly are selective in what we're putting into portfolios for clients.
Okay, so you're being selective. You walked me through some of the opportunities. Talk to me about which parts of the bond market do you feel are overvalued? And I get the sense from some of your earlier remarks, it's the sovereign end of the spectrum. Yeah,
that's where we, I'd say, you can question valuation. We would argue it does look overvalued. Could it stay there? certainly. But kind of the confidence again in monetizing any significant return from, call it the U.S. Treasury market, is relatively low, and the margin for error is high. So, there is return potential there, but I think we have less conviction in, again, monetizing it versus the credit market. And, it's not to call the end to, the role that government bonds have played in a portfolio, but at these levels of yields, your coupon versus kind of the duration risk you have there from a price perspective is just mismatched. And we think there's better alternatives in the market if you're thinking about how to build a risk-free end of the spectrum in a portfolio that give you better yield, similar or the same type of liquidity, and less kind of end duration risk. And one of those, for instance, for us is agency mortgages. We like those compared to nominal treasuries. We also think, selective high-grade corporate bonds, particularly with the Fed's support of that market, and call it that being directly under the Fed's umbrella, can be an interesting alternative as well, selectively to some of your traditional nominal treasuries.
Okay, so it all sounds well and good, Adam. I guess when I look at the performance of your fund and other credit funds, it's been a good couple of years. There's the blips seem to be fairly rare. So I guess my question would be, what's the risk? What's the risk of the credit bond bubble, if you will, bursting or something, stopping the performance of this market in its tracks? What's the risk?
Yeah, I think, certainly one risk would be just the complete shut off of the global economy again, right? That the virus morphs into something different, and we go back through a similar lockdown that created the significant economic turmoil that we saw earlier in this year. We place the probability of that very low. Certainly we have a lot of countries now, and certainly companies in the U.S. working on a vaccine. So it feels like a vaccine will be in the cards here. We'll have to see what the adoption rate is and how that's kind of taken up by the population. But I think a vaccine will enable growth. More fiscals expected to come as well. And I think fiscal is an important, stabilizer or floor to growth in addition to monetary policy. So let's say, although growth may not be exciting, we've seen an improvement in 2020 growth forecast, even from, the beginning of the year. And I think that kind of stabilization of growth is important. What's more interesting is this kind of move from kind of stable-ish growth, but differing outcomes for different companies, really being the focus of our attention, and how we can kind of focus portfolios on, for the liquid end of fixed income, the performing end of that spectrum where there's still value.
Okay, Adam, that's all the questions from me. Is there anything else you wanted to add? Any other views in fixed income that you wanted to get across today?
No, that's it for me. So, I really appreciated the time and the questions. Thank you.
Yep, no problem. In between your fixed income responses and the dad jokes, I think we have a good bond. Thanks for your time today, Adam.
Thank you.